Hello everyone, Karl Weiss with Fairway Independent Mortgage. With us today, of course, we have our esteemed guest, Mr. Seth Fink, and Seth is going to, as a CPA, is going to tell us about some more of the 2018 tax law changes for the federal taxes as they relate to us. And then what we want to do is sort of take a look at some of those changes and maybe help give some ideas, plant some seeds on how you might be able to take advantage of that to purchase a home in our market and or purchase maybe a slightly better home without it impacting your bottom line and your cash flow from a personal household perspective. So thank you again so much, Seth, for joining me and helping us get insight as a local tax expert. It's important that I think that we disseminate the real information because none of us read tax code, right? One of the bigger things that seems to be changing is as it relates to children and the child tax credit.
Right.
Can you take us through that and what that kind of looks like going forward into 2018?
Certainly. Well, there's actually two big changes when it comes to having children. The first is that there's no longer a personal exemption for yourself, your spouse, or any of your children. So last year, in 2016, for example, it was $4,050 of tax deduction per member of your household. That has been removed for the 2018 tax code. To replace that, they have increased the child tax credit from $1,000 to $2,000, and that's for children that are still under the age of 17. Some taxpayers would actually income out of that where they make too much to where they would no longer get that tax credit. They've actually expanded that phase out to be a much higher income level, so more people will qualify for that child tax credit. The tax credit is a reduction of actual tax, not a deduction from taxable income. Of that $2,000 tax credit, $1,400 of that is in fact a refundable credit.
Okay, so when we talk about the difference between deductions and tax credits are kind of like real money that are dollar for dollar offset of a tax bill.
Correct.
Where a deduction is just lowering the overall base that's getting multiplied by a tax rate.
Correct.
So if you have the choice between a deduction and a tax credit, you take tax credits till they hurt.
Correct.
Right? So when we're talking about a potential $1,400 swing, I know that doesn't sound like a lot to people, $1,400 in a year, but that's $116 a month. And that $116 a month on a paycheck basis essentially equates to what would be, a little bit over $20,000 of purchasing power for buying a home. If we knew that in January, if we did some calculations, is it feasible for a taxpayer to understand between the new tax credit where they might sit and then make some adjustments to their withholding?
For sure. I mean, we encourage everybody to look at the new tax code, figure out based on their income and their other situation what their tax bill at the end of the year would look like, and then make the changes in their withholding accordingly to get as close to a break even on their tax return as possible to maximize their disposable income on each paycheck.
And let's talk about that for a second, because I think this concept gets missed all the time. I have a lot of clients that come to me and say, Karl, I'm really excited about getting this tax refund. Explain to me what a tax refund really is.
A refund is really you overpaying your taxes. So people ask me all the time, how much of a refund will I get? And it depends on how much you've overpaid. What we look at as professionals, every dollar that the government refunds you is a loan you gave to the government interest-free. So we encourage clients to reduce their withholding to cover their actual tax bill, maybe with a small amount of cushion, without expecting to get that $5,000, $6,000, or $7,000 refund. That's money they can utilize each and every month towards their household budget.
Great. I feel the same way. The IRS does not need interest-free tax loans made to them, in our opinion. So having you have the power to have those funds on a monthly basis or per paycheck, however you're paid, gives you more power to make a good decision as it relates to the housing world. So, between the two big changes so far, the child tax credit and the standard deduction being doubled, the swing of those two numbers is for a lot of people probably in the lower tax brackets, we're talking about a change that would probably be about $35,000 to $40,000 in purchase price compared to 2017 numbers. And that would be a big deal, especially for anybody who might be out there shopping currently, to know and be able to predict for the future to say, hey, a lot of times there's break points, and if you're at a break point where you just can't find a house for sale in your bracket, having $35,000 of additional earning buying power is probably enough to get over that hurdle, to get out there and crunch some numbers. So, we definitely invite you to, take a look at those numbers. What would be the best way to have the clients do that? Would you like them to reach out to you to crunch those numbers? What's a good way?
Yeah, so for our clients that we work with, that's what we do. We encourage them to provide us the information we would need to go and work backwards and help them figure out what that withholding should be.
Okay.
So that way they can manage their lives. So for any of our clients who engage us, it's a service that we offer to do those tax calculations and figure out just what it would look like for them.
Okay, and while we're on the topic, are you still accepting new tax clients for the tax year?
Certainly.
What would be a profile of a typical taxpayer that would, every firm has different kinds of clientele that they typically work with. Tell us what the good mix would be.
Our firm focuses on business owners of every type. So our general client base is either single member LLCs to more substantive business owners. We also work with folks who are not business owners. That typically are moderate to higher income or moderate to higher net worth from the standpoint of being able to add value in the engagement that we work with. It's difficult for a firm like ours to compete with your H&R Block sort of place, but we're at a different clientele that we look for. We look for folks
Absolutely.
that we can add value and we can be their trusted advisor. We're there to answer questions and assist them, not just provide that commodity of that tax return.
Well, I can back that up. That's absolutely true. So, if you're out there and you see that and you're in the Phoenix metropolitan area and that fits your threshold as far as the type of client, and you have any questions, what's the best way for them to reach you?
And feel free to call our office and schedule a telephone consultation.
Okay, what's the best phone number?
602-274-3405.
And again, that's Focus, and of course Seth Fink is the CPA and owner of the firm. Thank you so much.
Thank you.